Have you ever wondered how investors can control assets worth thousands of dollars without actually buying them? How companies protect themselves from price changes? Or how traders profit from price movements without owning the asset? The answer is derivatives. And in this video, I will explain derivatives in the simplest way possible. If you are studying CFA, finance, or investing, understanding derivatives is essential, because derivatives are one of the most important instruments in modern finance. But most people make it sound complicated. So let's break it down, step by step. First, understand this simple idea. A derivative is called a derivative because its value is derived from something else. That something else is called the underlying asset. Simple. If the underlying changes, the derivative value changes. Imagine this situation. A farmer will sell wheat after 6 months. He is worried. What if the wheat price falls? At the same time, a bakery needs wheat after 6 months. They are worried. What if the price increases? So they make an agreement today. After 6 months, they will trade wheat at a fixed price. Now both removed uncertainty. This agreement is a derivative contract. A derivative is a financial contract whose value depends on another asset, called the underlying asset. Examples of underlying assets include stocks, bonds, interest rates, currencies, commodities, market indexes, even things like weather or credit risk. Forward contract example. Let's understand the simplest derivative, the forward contract. Suppose you agree today to buy 100 shares of a company at $30 per share after 3 months. Important terms here. The stock equals underlying asset. $30 equals forward price. 3 months later equals settlement date. 100 shares equals contract size. How profit works. Most important part. Now suppose after 3 months, the market price becomes $40. But your contract allows you to buy at $30. So what happens? You gain $10 per share. Total profit. 100 shares times $10 equals $1,000 profit. What if price falls? Now imagine price falls to $25, but you must buy at $30. So you lose $5 per share. Total loss, $500. This shows the basic rule of derivatives. Golden rule. Remember this rule. Long position gains when price rises. Short position gains when price falls. Forward buyer equals long position. Forward seller equals short position. CFA loves this concept. You will see this everywhere. Types of settlement. There are 2 ways contracts settle. First, physical settlement, where the actual asset is delivered. Second, cash settlement, where only profit or loss is exchanged. Both give the same economic result. Why derivatives exist? Very important. Derivatives mainly exist for 3 reasons: hedging, speculation, and leverage. Hedging. Hedging means reducing risk. Example, an investor owns stock. He fears price may fall. He uses derivatives to protect value. Risk reduced. Speculation. Speculation means taking risk to make profit. Example, a trader does not own stock, but believes price will increase. So he buys a derivative. Higher risk, higher potential return. Leverage. Leverage means controlling large investment with small money. Instead of buying stock worth $100,000, a derivative may require only $5,000. This increases potential return, but also increases risk. Main types of derivatives. There are 4 main types you will study in CFA: forwards, futures, options, swaps. Quick understanding. Forward, private agreement. Futures, exchange-traded forward. Options, right, but not obligation. Swaps, exchange cash flows. Big picture understanding. Here is the most important takeaway. Derivatives do not create risk. They transfer risk. From someone who wants less risk to someone willing to take risk. This is why derivatives markets exist. Quick summary. Let's quickly recap.
A derivative is a contract whose value depends on an underlying asset. Forward contracts lock future prices. Long positions gain when price rises. Short positions gain when price falls. Derivatives are used for hedging, speculation, and leverage. In the next videos, I will explain forwards in detail, futures contracts, options, and swaps. So if you are preparing for CFA or want to understand finance simply, consider subscribing, and I will see you in the next video.